Hi, this is Dave at AFX Search, Licensed Investigators. Once again, talking to you about preventing losses, especially when purchasing or acquiring a business. A lot of our clients are looking to expand their industry, maybe buy a business, maybe expand in an area of business by working with a vendor. And the main thing to look at in any kind of acquisition is to verify the figures that are being presented to you. Look, when you buy a business, you're going to a lot of times go by the representations made by the seller, how much revenue they have, what their expenses are. You want to verify that all that is true. In addition to verifying that, you want to make sure that the underlying value of the company is stable and it's secure. For example, if there's $1 million worth of revenue every year, first of all, you want to see that that money's come into the bank account. You want to see that those funds have come in, but also verify that it was actually revenue. It wasn't loans coming in. It wasn't proceeds from other sources that weren't actually sales revenue. The next thing you want to do is make sure that all of that sales revenue is durable, that those clients belong to the company. They're not going to disappear when that owner disappears, or that there's not some time contract that's expiring. For example, if there's $50,000 a month in revenue from a contract that's going to expire next year, that's really no good if you're buying the business based on that revenue being there long term. You want to see if those vendors or contracts with the entity that's being acquired have a good relationship with the company or just with individual people, because if that's the case, then those people really have the value. So that durability of client base is critically important. You also want to see if the specific market has some exposure or liability. It may be that there's a new law passed that makes some of the revenue non-existent going forward. There may be new regulatory requirements that increase the expense, which is the other side of the case. You want to see if those expenses are fair and reasonable. For example, if the company is showing a profit, but the owners are not taking out any salary, then really that profit is salary for principals, and then once those owners are gone, you have to either pay yourself or some other person to do those same tasks and jobs. So look at each expense, make sure it's reasonable, not too high, not too low. In many cases, a company that's for sale will artificially lower expenses for some period of time to make their bottom line look better, and that may be that people who are principals will lower the amount that they take out of the company. And if, for example, if an executive takes out $20,000 a year for a salary, but to replace that person's contributions in sales, management, or whatever the case may be, might cost you $150,000 or $200,000 for another qualified executive, then that throws the numbers out of whack, and that business may not be worth what you think it is. So verify the numbers when you're doing acquisition, and no matter what the situation is, even if once you verify the numbers, always put in a fudge factor. Make sure that the revenue that you're expecting, you cut it back by some percentage, 15-20%. The expenses that you think you have, ramp those up a little bit. Most businesses that are being sold will defer some expenses, maybe maintenance, maybe repairs, and maybe purchasing of equipment that's needed to run that business, deferring those because they figure, well, the next owner will have to do that. As soon as you walk into a newly acquired company, you may find that all the computers are obsolete, maybe the payloaders are broken, maybe the vehicle fleet is out of date. So expenses are going to be higher than what you think. Figuring that all in will make sure that your acquisition goes smoothly, and it erases the possibility of huge losses immediately.